So here we are. The markets are moving again. The S&P is trying to climb back up to what it was a few months ago. And generally speaking, you can see more hopeful headlines in the news talking about how the economy is going to get better. So the momentum feels real, right? But here's the thing. A lot of people, myself included, feel like this is a setup, right? This is a bull trap, which means if you're not careful right now, you might be buying right into the top of a short-term run that's going to get reversed really hard. I mean, there's evidence to suggest that actually we are going to go into a horrific recession very soon, thanks to Jim Cramer and his fantastic fortune-telling abilities. So in this video, I want to talk about how to invest when the markets look good, but it still feels kind of wrong. Because there's a way to stay exposed without getting burned. And it starts with one thing, which is being honest about the risks. So let's talk about the emotional trap of green candles, right? Momentum is seductive, which is why people buy at the top, right? You think, oh, surely it's going to keep going up, right? So you have this fear of missing out, FOMO. But in reality, there's a lot of things going on in the background that most retail investors, at least, aren't really aware of, to be honest. And that's things like, for example, the Fed doesn't want to cut the rates just yet, or at least adjust them. It's almost like everything is too good to be true. And when things feel too good to be true, that's when people start doing stupid things. So here's the thing. I'm not saying that you should be sitting on a whole pile of cash in a Warren Buffett kind of way and start panicking. But I'm saying that if you're going to keep investing, it's definitely important to keep some sort of defense baked into your investment thesis. So this could be a lot of things. I mean, it could be favoring equal weight ETFs. It could be tilting towards value or dividend payers. It could be avoiding high beta stocks. So those kind of companies that seem to be performing better now that everybody's performing worse. So you have to ask yourself questions. Are they going to be around in the long run? What's going to happen to them once everything fully recovers in the next however many months or years, whatever it could take? And keeping a little bit of cash on the side is a safe bet. We've seen people like Warren Buffett do that as of recently more than ever. As of today, 3rd of May, 2025, Berkshire Hathaway had its shareholder meeting. Buffett actually said that Berkshire was going to be cashing out even more now. So does he know something we don't? Something worth paying attention to. Some other stuff you could do is add optionality. So something that has a nice yield plus some, anti-fragility. So things like short-term treasuries, for example. And by doing this, you're being intelligent. Yes, you're waiting, but that doesn't mean you're losing. Other things to consider would be to do with gold, for example. Central banks are still loading up on it. Optionality matters more than bravado right now. So look, if this is a bull trap, and it might be, most people are going to buy too aggressively into it and then panic when it pulls back. You can't afford to move based on comfort or confidence right now. What you need is positioning without so much overexposure. You can be cautious without being a doomer, and you can definitely be exposed without being overcommitted. And that's how real investors survive. Not by predicting bottoms, but by managing risk when it's hiding behind these sweet, sweet green candles. Thank you for watching. I'll see you in the next one.